Hey everyone, John Henry here, and today in the market psychology video, we're going to be taking a look at the range here on gold. Now, it's Wednesday. We like taking a break from crude oil on Wednesday for the analysis, just to let them get the inventory stuff out of the way. Go a little bit crazy when you're keeping an eye on it through the inventory announcement. Can get a little bit a little bit crazy, I think is the best way to put it, yeah. So yesterday, we had this big spike down on gold, and they finished the job off and kept it going lower. Now, that drop lower came with a very big correction, right? Came all the way back up, even made a second leg to it where they got back to that initial breakdown point that we were talking about in the newsletter. So a nice drive down from that point, and they closed pretty high up at 1356.4. We opened up today as a gap down, right? We gapped very far down, not to mention, right? So we know that overall, this may be seen as somewhat of a breakout attempt from the sellers to take back the market. And given the follow through, well, it didn't exactly work too well for them, right? So we open up today and we have a pretty strong bull candle. There's a little bit of wick on the top, some wick on the bottom. So it's not the perfect candle that you would be looking for to potentially buy, waiting for a little bit of extra information. And then the very next candle is a weak bear candle in the opposite direction. And then the bears, if that was going to be one of those opening reversals where it pops higher and then slams lower by the sellers, well, they didn't do so hot either, right? And any seller who sold underneath that, you see that candle while you're in a short position, you're not going to hang on to it, right? You probably are going to get out of break even and think, well, yeah, that one didn't work so well. And you start seeing this semblance of a range. We're no longer getting the follow through from either side that we should be getting. There's no consecutive movement. It's back and forth. Lots of dojis, lots of wick. All of the strong candles completely failed. It's a really big clue in how we need to approach this in terms of trading. We know that the market psychology is going to be sellers are going to want to try to get this for a breakdown. And so far, they've been giving up every single time it's tried. So that means that we're probably going to have buyers on the other side that are trying to buy it for a breakout, maybe just to fill the gap. But given the follow through, the buyers aren't doing well either. And what does that tell us? Well, folks, we're in a range, right? We're looking to sell high and we're looking to buy low. And we're going to assume that every single attempt to break out of this range is going to be a failure until proven otherwise. And even when you are proven wrong that the breakout actually did succeed, it still almost always comes back, right? So that's the situation that we find ourselves in. Range bound. Any breach of a prior candle's high or a trap or anything to get going on one side to trick a bunch of traders in is the perfect place to go against them, knowing that it's more likely going to be a trap. We broke above those highs, immediately wicked above it, and snapped right back down again after trapping in sellers, only to trap in breakout buyers to turn back down. That is a beautiful range high sell, looking for a run back to the opposite side of the range. Now, we do have some really strong selling candles, and we know that sellers will probably take them, but what do we know? Well, it's probably going to be a range, and we need to be buyers at the lows of the range. And it is exactly what occurred. We pushed down to the range, buy the lows of the range, expecting rotation back up towards the highs. One key thing to remember when you're dealing with a range like this is stay the heck out of the middle, right? Look at this chop back and forth. You do not want to find yourself stuck in this. You want to be getting in at the extremes and stay out of this. This is a big red box here for a reason. You don't want to play around in that. And all of this back and forth shows you exactly why that is the case. We push back up to the highs. We go back to the overall highs. We're looking to sell. We're not looking for this breakout to succeed. Yes, it closed above it. Yes, it's a very big candle. Yes, they had decent follow through and then immediately turned right back around. So we know that sellers are fading into this move, assuming that this entire breakout attempt is going to fail, at least back to retest the original range, maybe even come in a little bit farther to where we last saw the buyers and sellers fight, right around this area here. And that's exactly what happened. Selling above the highs of the range, assuming that the breakout's going to fail, allowed the market to pop right back in, come back to quote unquote fair value for the buyers and sellers to punch each other in the face some more. So beautiful example of a range and picking up on the range and staying out of the middle on a range day. Very important if you want to keep your account intact, to stay away from the middle and just look at the extremes and try to get in, assuming that the breakouts are going to fail. Buy low and sell high, and that's the motto of the game when you're talking about a range day. So that's going to do it for this one. Hopefully you found it useful. Hopefully you found it entertaining and you learned something, and we'll see you next time.